This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Let me tell you the real reason most beginners fail at trading. It is not their strategy. It is not that they can't read a chart. It is not that they picked the wrong stock. Most beginners blow their accounts for one brutal mathematical reason. They risk too much, and a single bad trade, or one bad losing streak, wipes out everything they spent months building. Here's the part nobody wants to hear. You could hand a beginner a genuinely profitable strategy, one that wins more than it loses, and they would still find a way to blow up. Because they'd risk half their account on one trade that felt like a sure thing, that trade would lose, and the strategy never even got a chance to work. This is the lesson that separates the traders who are still here in a year from the 90% who quietly disappear. It's not the exciting one. There are no secret patterns here, no magic indicator. This is about survival, because you cannot win the game if you're forced to leave the table. In this lesson, I'm going to show you the math that destroys accounts, the simple rule professionals use to make sure a losing streak can never take them out, the exact formula to size any position, and the 6 rules that keep you in the game long enough to actually get good. Protect your capital first. Everything else comes after. Let's get into it. Let's kill a myth right now. Beginners obsess over the entry. Which pattern, which indicator, which setup has the highest win rate? They think if they can just find the perfect strategy, the money follows. But here's the truth the pros know. Your entry is maybe 20% of the game. Risk management is the other 80%. Think about 2 traders using the exact same strategy, a strategy that wins 50% of the time with solid setups. Trader 1 risks a fixed 1% of his account on every trade. Trader 2 risks whatever feels right, sometimes 5%, sometimes 20% on a trade he's really confident about. Same entries, same exits, same win rate. Over 100 trades, Trader 1 grows steadily, riding out the inevitable rough patches. Trader 2? He hits a normal, completely expected string of losses, 4 or 5 in a row, which happens to everyone, and because he was betting big, that streak takes 60–70% of his account. Now he's panicking, trading scared, making emotional decisions, and it's over. Same strategy. One survives and thrives, one blows up. The difference was never the strategy, it was the risk. This is why professional traders talk about defense before offense. Amateurs ask, how much can I make on this trade? Professionals ask, how much can I lose, and can I survive it if I'm wrong? Once you truly internalize that trading is a game of survival first and profit second, everything changes. So let's look at the math that makes survival non-negotiable. Here's the math that should be tattooed on every trader's brain. It's called the drawdown math, and it is merciless. When you lose money, the gain you need to make it back is not the same as the loss. It's bigger, much bigger. Watch. If you lose 10% of your account, you need to make about 11% to get back to even. Not bad, manageable. If you lose 20%, you now need 25% just to recover. Lose 30% and you need 43% to break even. But here's where it gets terrifying. If you lose 50% of your account, cut it in half, you do not need 50% to recover. You need 100%. You need to double what's left just to get back to where you started. And if you're reckless enough to lose 90%, you need to make 900% to break even. That's essentially impossible. Sit with that for a second. The deeper the hole, the exponentially harder it is to climb out. A small loss is a bump. A big loss is a trap you may never escape. This is exactly why professionals are obsessed with keeping losses small. It's not fear, it's math. A 10% drawdown you can recover from in a few good trades. A 50% drawdown can end your trading career, not because you can't trade, but because the mountain you now have to climb is so steep it breaks you psychologically long before you reach the top. So the entire goal of risk management is simple. Never let a loss get big enough to put you in that trap. And that starts with one rule. The rule is this: risk only 1–2% of your account on any single trade. That's it. That's the foundation everything else is built on. Let me be precise about what this means because beginners misunderstand it. It does not mean you only buy $100 of stock. It means the most you can lose if the trade goes against you and hits your stop is 1–2% of your account. On a $10,000 account, 1% is $100. So no matter how confident you are, no matter how perfect the setup looks, the absolute most you'll lose on that trade is $100. Now watch why this is so powerful. If you risk 1% per trade, how many trades in a row would you have to lose to cut your account in half? Around 69. 69 losses in a row. That basically never happens with any real strategy. You are, for all practical purposes, unblow-upable. Now compare that to the reckless trader. Risk 10% per trade, and it only takes about 7 losses in a row to lose half your account. 7. Every trader on earth hits a 7-trade losing streak eventually. It's not bad luck, it's just variance, it's normal. The 1% trader shrugs it off. The 10% trader is wiped out. Risk 20%, and just 3 bad trades in a row ends you. This is the whole secret. Small, fixed risk means the losing streaks that are guaranteed to come, because they come for everyone, can never take you out of the game. You lose a little, you stay calm, you keep executing your edge, and you're still standing when the winners show up. Survival is a choice you make on every single trade, with your position size. So how do you actually make sure you're only risking 1%? This is where beginners get lost, so let me give you the exact formula. It's simple, and once you use it a few times, it becomes automatic. Here it is. The number of shares you buy equals your account times your risk percent, divided by your entry price minus your stop price. Let me walk through a real example. Say you have a $10,000 account and you're risking 1%. That's $100 of total risk. Now you find a setup. Your entry is $50 a share, and based on the chart, your stop loss belongs at $49, just below the structure. So your risk per share is $1. 50 minus 49. Now divide. $100 of total risk divided by $1 of risk per share equals 100 shares. That's your position. Buy exactly 100 shares. If the trade hits your stop, you lose $1 per share times 100 shares, exactly $100. Exactly 1%. Not a penny more. Here's the beautiful part, and this is the insight that makes you a professional. Your stop distance no longer controls your risk. Say the next setup has a wider stop, $2 away instead of 1. Same formula. $100 divided by $2 per share equals 50 shares. You buy fewer shares, so you still only risk $100. Wide stop, fewer shares. Tight stop, more shares. Your dollar risk stays locked at 1% every single time, no matter what the chart looks like. You never again eyeball a position or trade a random number of shares because it feels right. You calculate, every time. That discipline is what keeps the drawdown math from ever getting its hands on you. Let me show you what this looks like over a series of trades, right after this. Quick pause. Managing risk is really about protecting your future, and that mindset applies way beyond the charts. If you're working on the career side of your life too, and you need a resume that actually gets you in the door, check out ResumeZenith. Clean, professional resumes built fast. Link in the description. And if you're getting value from this, please hit that like button, subscribe if you haven't already, and tap the bell so you never miss a lesson. This is the stuff that keeps traders alive, so help me get it in front of more people. All right, let's see risk management in action. Let me show you 2 traders taking the exact same 20 trades. Same wins, same losses, same order. The only difference is how much they risk. Trader 1 risks 1% per trade. Trader 2 risks 10%. Both start with $10,000. Early on, there's a rough patch, a few losses clustered together, which is completely normal. The 1% trader dips a little, no big deal, and then the winners pull him steadily higher. Smooth, controlled growth. The 10% trader, those same early losses gut him. He's down 40, 50% before the good trades even arrive, and now he's trapped in the drawdown math, needing a massive gain just to recover, trading scared, and the account never comes back. Same trades, one grows, one dies. Now the fastest way to violate all of this and blow up in record time has a name: averaging down. Here's how it kills people. You buy a stock at 50, it drops to 48. Instead of respecting your stop, you think, great, it's cheaper now, I'll buy more and lower my average. It drops to 46, you buy more. 44, more. Each time it feels smart, like you're getting a bargain, but what you're actually doing is throwing more and more money at a trade that is actively telling you you're wrong. You're turning one small, planned 1% loss into a massive, account-threatening position built entirely on hope. This is how a trader who is going to lose $100 ends up losing thousands. A stop loss would have capped that first loss at 1% and gotten you out. Averaging down removes the stop and replaces it with prayer. Never add to a loser. Add to winners, never losers. Write that down. Now let's tie your risk to your edge with one concept that pulls this whole series together: expectancy. Expectancy is what you earn, on average, per trade over many trades. It's the number that tells you whether your trading actually makes money over the long run, regardless of any single result. Here's the formula in plain English. Take your win rate times your average win and subtract your loss rate times your average loss. If that number is positive, you have an edge. If it's negative, no amount of position sizing will save you, you're just losing slowly. Let's use the numbers from Lesson 8. Say you win only 40% of your trades, but because you follow the 1-to-2 risk-to-reward rule, your winners are twice the size of your losers. Over 100 trades, your 40 wins each make 2R, that's plus 80R. Your 60 losses each cost 1R, that's minus 60R. Net result, plus 20R over 100 trades. You're clearly profitable, winning less than half the time. This is the point that reframes everything. You do not need a high win rate. You need positive expectancy and enough trades for it to play out. And here's how risk management connects. Positive expectancy only makes you money if you survive long enough to place all those trades. If you risk too much and blow up on trade number 12 during a normal losing patch, your beautiful positive expectancy never gets the chance to work. Small risk keeps you in the game. Positive expectancy makes the game worth playing. You need both. One without the other is useless. So let's lock this in with the 6 rules that keep you alive. These aren't suggestions. Break them, and the market will eventually remove you from the game. Rule 1. Risk 1-2% of your account per trade. Never more, no matter how confident you feel. Confidence is exactly when people blow up. Rule 2. Always use a stop loss, and set it before you enter when you're calm and objective. A trade without a stop is an open-ended bet against the entire market. Rule 3. Never add to a losing trade. No averaging down. If price hits your stop, you're wrong, you're out, you move on. Rule 4. Only take trades that offer at least 1-to-2 risk to reward. If the math isn't in your favor before you enter, don't enter. Rule 5. Cap your day. Set a limit, say 2 or 3 losses in a row, and when you hit it, you're done for the day. This stops one bad morning from becoming a catastrophic afternoon. Rule 6. No revenge trading. When you take a loss and feel that hot urge to immediately win it back, that is the single most dangerous emotion in trading. Walk away. Reset. The market will still be there tomorrow. Notice something about all 6 rules. Not one of them is about making money. Every single one is about protecting your capital, controlling your losses, and managing yourself. That's not an accident. Professionals don't focus on the upside. They obsess over the downside because they know if they take care of the downside, the upside takes care of itself. Protect your capital first. Profits are simply what's left over after you've survived. Homework time, and this one might change how you trade forever. 2 parts. Part 1. Figure out your personal risk number. Take whatever account size you're planning to trade with, real or hypothetical, and calculate 1% of it. Write that number down. That is the absolute maximum you are allowed to lose on any single trade from now on. Tape it to your monitor if you have to. Part 2. Practice the position sizing formula until it's automatic. Pull up 5 different charts on TradingView. For each one, imagine a real entry and place a logical stop based on the structure, like you learned in Lesson 8. Then run the formula. Your 1% dollar risk, divided by the distance from entry to stop, gives you your exact share size. Do it 5 times. Notice how the share count changes with every trade. Tight stop, bigger position. Wide stop, smaller position. Same 1% risk every time. By the 5th one, you'll be able to do it in your head in seconds, and you will never again pull a random position size out of thin air. And of course, I've put the drawdown math, the 1% rule, the position sizing formula, and all 6 survival rules into a free cheat sheet. Go to candlelogictrading.com, drop your email, and I'll send it straight to your inbox. Print it out. Keep it next to you when you trade. So here's where you stand. You can read market structure. You can mark the levels that matter. You can spot the patterns and the single candles that signal a turn. You can build a complete 5-part trade plan. And now you know how to manage risk so you survive long enough for your edge to work. You have all the pieces. In the next lesson, Lesson 10, the final lesson of this beginner series, we put every single thing together. I'm going to walk you through one complete trade, from a blank chart all the way to a planned, sized, executed setup, using everything you've learned across all 10 lessons. It's the lesson where it all clicks. You will not want to miss it. New lessons drop every Sunday, Tuesday, and Thursday. Hit that like button, subscribe if you haven't already, and tap the bell so you never miss a lesson. I'll see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.